tends to refer to them as risk factors. So each of those is an indication of the extent to which this particular risk factor impacts on this particular stock or share. Does that help? Does that make sense? Okay.
I have one question. How can I apply CAPAM or arbitrage pricing model to evaluate the portfolio, the new project development? Because I think it's the same theory, but can you give me one guidance? How can I apply the same theory to evaluate my portfolio project? For example, how can I apply CAPAM? How can I apply arbitrage pricing model?
Well, you've got to debate first about which of those best represents the risk premium. So it's not as simple as saying, well, how do I apply? The point, I guess, in terms of trying to use the figures that result from either of those would go back to my earlier slide that said if you think the level of risk is the same, so in the same risk class, then it should be possible to use estimates of beta or estimates of B1, B2, and so on in determining your required rate of return. I guess that's what you could do. But when you're talking about new product development, the question would be whether looking at the past is appropriate for identifying those risk premiums. And that I can't answer because it depends on the new product that you're thinking of introducing. So the principle is there, but you have to work out whether that principle actually works given the application that you're trying to put it to. And I can't do that for you. I don't know about your new products, nor what I know about the markets you're trying to introduce them to.
Another question.
Yeah, another question.
Normally, macroeconomics models speak of exchange rate.
Yeah.
Notice that in this discussion, there's nothing showing an impact of exchange rate on this animal.
No, agreed. This is what Chen, Roll, and Ross found. I can't remember off the top of my head, though you could always have a look at the paper, whether they actually considered the exchange rate in there as well, or maybe unanticipated changes in the exchange rate. I can't remember. But what they found was, after going through quite a lot of analysis, that repeatedly, these were the factors that seemed to be most important. Now, what I can't say off the top of my head is does that mean they found the exchange rate not to be important, or is it that they didn't include it in the first place? I can't remember. Yeah, okay. Right, so conscious of running slightly out of time and not wanting to drag this out too long, if this works. Right, so that's what I've just said, essentially. What they found was that all of these factors seem to have an influence. Third kind of fairly influential paper or fairly influential model is something that comes a bit more recently, and it's quite often referred to as the three-factor model, as you can see. And here, at one level, I guess you can think of it in terms of an extension of CAPM. So not only do we have the market return, but the suggestion of Fama and French in this particular article here was that two other factors were likely to have an influence. Again, they use monthly data, and again, we have a kind of regression approach. Specifically, and maybe this is the easiest way to do it if you're actually doing this analysis, they focus upon the risk premium. So it's the return for a particular stock minus the risk-free value. And then what we have here, B1, which is essentially our notion of beta. But what they're suggesting also is that two other factors could influence the risk-return relationship. So could influence the risk premium and indeed the required risk premium. The first of those, again, this is a very shortened definition compared to what's in the paper. If you want to see exactly how the calculations were done, I guess you need to look. But the first of these was in terms of a risk factor related to size, as you can see. So that SMB represents something related to the size of the particular organisation. The suggestion is size, small versus big, can have an influence on the risk-return relationship. In the same way, there's a risk factor here related to, and I'm never sure if this is the right way around, but this is how they phrase it, book to market value. So here, the difference between high, so I've always thought this is the wrong way around, but anyway, high and low book to market value stocks is the suggestion. And again, that's something that's priced within the market is the suggestion, which is why we get values for B2 and B3. And I think the shorthand is something like small minus big and high minus low. So that's the kind of phrases that, that Fama and French eventually came up with. And then, so those were three kind of classic papers, it strikes me. And then I did a little bit of search to try and bring things more up to date. Here, not knocking what I've got on the slide, but here, I guess at the moment, we're not talking about classic papers. We don't know yet whether they will be classic or not. This, I think, I was looking around, and I can't remember exactly where I got it from, but I think it's a conference paper. That's my hunch. And this doesn't actually present any original research, but what it is a very good summary of research that's been conducted in the late 90s and in the 2000s. And the way in which that research seems to be going, and I think I've labelled a few of these here, that in addition to the market return, in addition to the two factors that have been identified by Fama and French, more recent research suggests that there are other variables specifically related to an individual company that can also have an influence on our return. So in a way, this research is moving us back a bit from that notion of CAPM and back a bit from that notion where I drew the little picture and said the only risk that will be priced is market risk. Because here there seems to be a suggestion that things relating to the company itself, so specific risk, is also being priced here. But that is sort of fairly early days, and how far that particular research develops. I can't remember if they're actually still alive, or whether Fama and French come back and show something else that suggests no, that's not true. We cannot say for sure. And a couple of final things to say, and then maybe open it up to more questions if anybody's got any. I think on reflection, this isn't quite what I meant, all right? But I was trying to finish this off just before I got on the aeroplane to come across from England. I think what I'm trying to say here, even though there's lots of theoretical ideas, lots of suggestions as what determines stock returns historically, that does not mean that in some sense you can use these models to beat the market, to somehow make a profit. So it wasn't, predict per se. It was thinking about beating the market, identifying some stock and saying, well, I'm going to buy that, and because I know about these models, I'm bound to win. That I think is not possible. All right, so that's what I was trying to say, even though it didn't maybe come out quite right. And one of the reasons why that's the case goes back to my very first, I'll just put all of these up, I think you've got it in front of you. My very first slide, which said about, intrinsic value or animal spirits, okay? Whichever of those you subscribe to, still, as I said, there's an impact from new information. But the argument is, if you believe any of this, I'm not going to read it out, you've got it in front of you, but if you believe any of this, then everybody gets the new information at roughly the same time, and hence there's no way that you can do things faster than anybody else. So again, there's no way that you can benefit, there's no way that you can beat the market. And in terms of the ideas here, somewhere, okay, the only bit maybe where it occasionally might happen is where you've got inside information, so you know more than anybody else, but as soon as you try to benefit from that inside information, then you're telling everybody else about it. And so even there, the argument is very little benefit. So maybe I have said something about what determines stock returns, but only historically. Yes, not what's going to determine next week or the week after. And I think maybe that's a place to leave it. All right, thank you. Thank you.